Welcome back. Well, a flattish start on the Nifty is what we're seeing, but a lot of companies are reacting to its numbers. And Cholamandalam Investment, well, they posted a mixed set of numbers. The business momentum looks strong, with the AUM rising close to around 20% in comparison to last year. Dispersals as well were up nearly around 70%. This, however, has not translated into profit growth. The NIMs have come down to around 7.6% odd, but that's something that the management had guided for in the last time we chatted. Well, Mr. Arun Selvan D, the president of the company, as well as CFO, joins us. Hi, sir. Morning. Thanks so much for joining in. Well, a couple of factors we want to focus on. One is on the NIMs. They've come down to around 7.6%. Now, I think your cost of borrowing has moved up a little bit, and effectively 50% of your borrowing is on floating rate. So what's the guidance on the NIMs from here on? Will it hold at around the 7.5%? And earlier you were guiding for AUM growth of around 15%, I think mid-teens. Do you want to revise that number?
Yeah, the AUM growth will be a little bit more stronger is the current prediction going by what we have seen as the growth in Q2, and we expect more traction on the disbursements in the coming quarters, being good festival quarters as well as good harvesting that's expected in the Q4. So we will look at around 20 to 22% AUM growth as we move forward for the full year. And if things pan out better, it can even be better than that. With regard to the NIMs, I have spoken earlier also. For the full year, we expect the cost of funds to increase by around 50 to 60 basis points going by the trend. And as of YTD level, the cost of funds is still lower than compared to last year. But yes, as a quarter on quarter, that is Q1 versus Q2, there has been a drop because of the cost of funds increase. This is expected, and this is what we have guided, as you rightly pointed out. We expect the NIMs to hold in around the 50-60 basis points, but that would also be predominantly driven by the mix of what products we do. So that is something we will keep revising as we move forward, because the market, based on market, we will be moving with scaling up or scaling down on the products that we do, where the yields are very wide.
Okay. Mr. Selvan, good morning. So consolidated AUM grew 25% in the quarter. You're saying for the full year should be somewhere in the region of, you said 22, 23%, right?
Correct.
Q3 and Q4, but are good quarters, right? There is a bit of an acceleration. So how should one read this?
No, I just want to be a little bit conservative, because while monsoon is good, etc., we still want to see the traction that's happening in the SRTO segment, which we are focusing on within the vehicle finance. The new businesses that we have been scaling up are of shorter tenor to a large part of the business. So the churn will be more, but it may not ultimately result in the AUM growth significantly. The LAP and HL are growing faster. They will contribute to a large extent because they stay on the book for a longer period, and that would be helpful. I think we will give you a more clearer reasonable target by end of Q3 rather than now, because we want to assess Q3 before we give a larger number on the AUM growth.
Sure. Okay, so for now, we'll go with this 20 to 22% AUM growth target that you've put out. Mr. Arul Selvan, good morning. Within vehicle finance, you cater to a lot of the segments, right? Whether it's two-wheeler loans, commercial vehicles, tractors, even construction equipment. And since your loans are largely low ticket, you start from 1 lakh onwards, you'll be able to give us a better sense of how the rural market is recovering, because we are seeing some nascent signs of recovery, but it's not as strong as what we're seeing in urban. So you tell us, what is the situation on the ground, and within the vehicle piece as well, which one is recovering the fastest?
Yeah, so the rural market is, as you know, highly dependent on the monsoon. While overall monsoon seems to be good or above average, pockets of areas have shown different, levels of either shortfall in monsoon or, in some places excess. So this to some extent skews the rural income. So that's where we are also being little, conservative with regard to our approach on committing higher numbers on AEM growth. Uh, but the way forward is looking at the coming festival seasons and a reasonably good harvest, for a predominant part of the country, especially in the context that we are spread all over the country almost equally. So we would, while there could always be some regions or geographies where there can be impact, we will see some amount of reasonable growth in the rest of the locations. And the other factor that needs to be also considered is the government spending that is expected to happen, especially in the context of elections coming up shortly. So that should again put up a more earning potential in the hands of the consumers, triggering consumption and thereby triggering vehicle requirements for movement of material. This is the long and short of it. So we expect a reasonably good traction in the rural segment, and to some extent it will be dependent on a good harvest that comes up in the Q4.
All right. So, you said your cost of funds could go up by around 50 basis points, but you're still sticking to NIMs of around 7.5%. Should we work with 7.5% or 7 to 7.5%?
Yeah, I would say so. See, as a little while back, Sonia mentioned, the mix of our vehicle finance book is very wide. We have, yields ranging from 10.5% to as high as 23-24%. And we keep moving between these products in the context of how the demand picks up in which segment. And we have the expertise to do any of these product lines. We have demonstrated that over the period. But that is the crux, and that is also to a bit, the reason for our success in spite of various, movements in the demands for various products. But this has an impact on NIM because the product yields are different. But on the flip side, the higher yield products will have higher OPEX and higher NCL. So to that extent, it will offset a bit. So while we do higher yield product, you may also have a higher OPEX. So the NIMs can move depending on the product mix, but the ROTA is what we focus on to make sure that we deliver a pre-tax ROTA of around 3 to 3.5%.
All right. Mr. Selvan, thank you very much for joining us. Good speaking with you. Appreciate you joining in with that perspective. So, the commentary is good. The guidance is a bit conservative. I want to be conservative, but we'll see. Chola right now about 1.25% higher. The market's absolutely flat, 13-14 point change, so not very much going on. Look at something like a Supreme Industries. It's one of those completely not bombed out stocks, but it's not done very well for a long time, but starting to make a move. 3 days in a trot now. It's up another 3%. Yesterday was a good day. Day before was a very large day. It reported numbers which were not all that great as well, but stock is moving as we speak. All right, let's move on and talk to Kansai Nerolac, which is the next company which we're speaking with on earnings. Revenues grew 19% in the quarter, aided by revival in auto demand. But the decorative paints business was muted. That's the high margin business, something the management believes could continue into the third quarter as well. Anuj Jain is Managing Director at Kansai Nerolac Paints. Anuj, good to have you with us here. Thank you very much for your time. So let's just start there. What kind of, first of all, in the decorative segment, what was the volume growth? What are you expecting in the third quarter? Because, sort of rains extended all the way into October, right? Late October in some areas, some parts of the country. So Q3 should also be muted. If you can provide us with some numbers, what's the expectation?
Yeah, so in decorative business, the value growth was about double digit, and volume growth was on the lower side. And yes, the extended monsoons affected because last year Diwali was in the month of November, and generally for last 2-3 years we are seeing a trend that the rains continue till October, and this time it was continued till 15th of October. So I think to that an extent, even the month of October got impacted. So I think this year, when we look at this particular year, I think that the growth factors in the quarters would be a little lopsided. So maybe 2 quarters are good, 2 quarters are not so good, but overall year would be okay.
Mr. Jain, so when you say the volume growth is on the lower side in the decoratives business, can you give us a number? How much was the volume growth this time? How much has it fallen compared to, say, the preceding quarters?
So volume growth in decorative is almost, you can say, flat, because it depends on the business mix. So, there's a paint, and then there are a lot of new segments like putty segment. So putty growth is a little negative. So overall volume growth is flat.
A larger peer, Mr. Jain, Asian Paints, they reported double-digit volume growth. So this flattish number is something that the street is not too impressed about. But be that as it may, you have also guided for a softish quarter 3. You're sounding quite cautious. Is it, for an industry-wide phenomena, or are you being a little conservative?
So it's an industry phenomena. And secondly, now when we compare, I think the numbers are not comparable, because paint is not only paint now. Paint is divided into paint, putty, new businesses. So how and it's not that every player is playing into each and every field. So if we look at ex-putty growth, it is positive. So I think relatively it is not comparable. And industry phenomena, as I said, that during the year, 2 quarters would be good, 2 quarters may not be that good. The sale before Diwali, which is in the month of October, definitely got impacted. The only optimism or positive part could be whether that deferment or people who wanted to paint before Diwali, whether that sale will come back in the market post Diwali. I think we'll have to wait and watch.
Right, but quarter 3, you're saying it could be softish, industry-wide phenomena. Margins, that's something that the street will be hoping for, Mr. Jain.
In the decorative, yes, but I think the good run of
autos will continue. Okay, all right. The street will be hopeful that margins improve from here on. Now, you must give us some color out here. How much can it improve going by the cooling off of cost? Maybe for quarter 3, you could give us some bit of an improvement number and some guidance for quarter 4 as well, where I guess bulk of this cost saving could come about. Go ahead.
So the inflation continues. There is that cooling of the raw material prices, but I think the overall inflation continues. And what happens is, like, if you see the auto business where the growth is good and the supply chain challenges still continues because of geopolitical situation. So obviously we have to keep a little higher inventory to ensure that our services to the customer is not impacted. So I think the impact of cooling off prices would be somewhere reflected in the quarter 4.
Is there a need for more price increases, Anuj? Let's assume raw material prices stay where they are. Is there a need for more price increases? And by when will margins revert to pre-COVID levels?
We have taken almost about 3% price increase.
Yeah.
And I think, that the way the trend is there in the raw material prices, I think we'll wait, and there's no need to take further price increase. Okay. But in automotive, we have taken some price increase, and we are definitely working with our customer to get more price increase.
And given all of this, any broad idea when margins could get back to pre-COVID levels?
So we'll have to see, as that we stated that in decorative we are increasing our investment in marketing and advertising. So it's like some kind of investment which we are making the decorative. So margins will improve in the industrial side, but to some extent in decorative the investment what we are increasing. So I think we'll have to see that how does it get resulted into a better revenue.
The issue really is that there's, of course, a lot of competition now kicking into this space, and your market share has been in this single-digit range for a while, right? About 9% or so. Are you doing anything to gain market share, and what are your targets? I mean, any year-end targets that you would have?
So as we have stated earlier also, I think, it's like one has to make a choice that, where exactly you want to increase the share. So as of now, our focus in terms of increasing our mix, so whether it's a decorative business or industrial business, all segments, we are working to increase our mix. So we have been a good player in popular and economy segment, and the premium is one area where we are, trying to increase our market share, and that is what we are looking at.
Okay, all right.
Any targets that you would have in the premium segment? You said you're looking to increase share.
So I won't be able to speak about the target, but the salience in our case was lower than 15% in the premium segment, and while for market it could be higher than 20%. So we are looking at increasing our salience from upward to 15%.
Okay, all right, Mr. Jain, I need to press you a little bit on the margins yet again. Putting everything that you said, give us a number. How much can it improve? Can we work with 100 basis points improvement in quarter 3 in comparison to quarter 2?
I think the reflection of the prices you'll be able to see in the quarter 4. So quarter 3, as I said, that there would be some pressure in terms of demand. Maybe I'm a little conservative on that, but probably the demand outlook for decorative may not be that good for the quarter three, and quarter four, the demand outlook is also good, and whatever. Because some volatility we have to keep in mind. Like today, if you see
Mr.
the
Jain, Mr. Jain, you said all of that. See, from around 10.5% odd by quarter four. Let's leave quarter three aside. As you said, it could be softish for the industry. But should we work with around 12% margins? Can you go back to those levels in quarter four? Is it possible?
So generally, we don't give any guidance. So, I would say that I can only give you indicators and that you can read out of it.
All right, Mr. Jain, we leave it at that. Thanks a lot for joining in. I think, that is the disappointment, right? The fact that margins, the decorative paints business in any case has been muted. Margins also have been under pressure. Gross margins are flat. So stock is down about 2.5%.
All thanks to auto, Sonia.
Yes.
For the, which... Thanks to autos, because that's a segment which has done well, for them, the industrial segment, auto
saved
segment.
by the autos, especially the electric vehicles and the surge there. But by the way, look at the market, right? The mid-cap index is now picking up a bit of pace, looking quite good. In fact, a lot of stocks are just gaining ground as we speak. Pharma, don't lose sight of names like Alembic Pharma, Piramal Pharma, Max Health, Aster DM. Gland Pharma is coming back after deep cuts, so up almost about 3%.
So, a pretty unexciting day so far. 18 points is what you have. 18,128 on the index. Mitesh Thakur is back with us with what he's making of things. Wait and watch it is, Mitesh. Name of the game today. What would you do? What are your trades?
So I think on the index, it's a very quiet day. But, what we can have as a reference is yesterday's low, 18,060, and then 18,020 was the gap level. So I think that band is the area where traders can possibly explore buying. But otherwise, trade with stock-specific biases. I think Record Financial Services, after a long time, is giving a breakout on the hourly and the 2-hourly chart. So buy here with the stop below levels of 29.10 for targets of around 3,000 to begin with. And the other stock which I like is Steel Authority of India Limited, SAIL, that's breaking out as well with this. That's a buy with the stop at about 79.5 for targets of around 86.
All right, Mitesh, thank you very much for that. So that's technical trading ideas coming through. All right, let's talk about commodities and the price action there. What's top of mind? Manisha is here to run us through that. Manisha, hi, good morning.
Prashant, morning. Thank you for that. While the global markets clearly are watching out for the US Fed meeting, back home as well, it has been quite a newsy week if you look at that, whether it has been about wheat or sugar, but edible oil prices is what I'm talking about right now. And we did see that notification come in from the government where the stock limit has been removed for edible oils and oil seeds. Remember, this was put in the month of Feb for a couple of months and then extended up to nearly December 2022, and it has been revoked as of now. This is the kind of stock limit that the market was dealing with for retailers, wholesalers, retail outlets of big retail chains and big retail depot as well. This is a stock limit that was put, and this has been completely taken off right now. Same is the case with the oil seeds as well, where you had retail and wholesale stock limits in place. That has been taken off at this point in time. Now, the prices, if you look at that, have come to pre-COVID levels, and is the reason that the government has taken this step. If you look at the prices, they're down between 30 to 45% for various oil seeds and edible oils there. Wholesalers and big chain retailers are exempted from stock limit with immediate effect is what the notification said. And it also says that they would now be allowed to keep stock varieties and different brands as well. That is something that they were also barred from. If you look at the stock limit removal, that would also boost the procurement of oil seeds. Remember, this is harvest season and there's a lot of arrival right now coming in for the markets. So the private players can actually go out, procure, and that would boost the prices and the farmers' income as well. As I said, the government had imposed stock limit in Feb 2022. It was for 2 months. It was extended up to December, but now it has been taken off. When you look at the Indian imports as well, that has been slightly lower on a year-on-year basis. Last year, we saw 13.3 million tons of edible oil imports into the country. It still continues to remain on the higher side. Remember, India imports nearly 60 to 65% of its edible oil requirements. It depends on imports that much. This is what the prices clearly have done and is the reason the government has taken this step as well. Last year, the prices were 9,500 rupees per quintal. They've dropped to 4,500 right now. Same is the case with mustard, from 8,500 to 6,000 is where we are trading right now. So good news definitely coming in for the companies, FMCG as a sector and raw materials. When you look at the futures market, that is what the street is really watching out for. So with one thing now done, the other thing is markets awaiting the permission for trading in futures for mustard, soybean as some of the commodities. It was a blanket ban that the government put in the month of December 2021. It was done for 1 year. The deadline comes in for December 2022. With the arrivals already coming into the markets and prices very volatile, the ask from the industry is to reinstate the futures trading in many of these commodities. So while it has been about soybean, soy oil, mustard, palm, all of these commodities is what the street is asking for. And then apart from that, it has been about chana, wheat and paddy as well, which was suspended, which markets believe will come back in trading by December.
All right, Manisha, thanks very much for that. Well, let's commodities in focus. Now, LIC Housing Finance is taking a hard knock today. Let's revisit that. Abhishek is standing by to tell us why. Abhishek, hi.
Hi, Prashant. So it was a very weak set of P&L from LIC Housing Finance, given the fact that the net interest margin came in at 1.8% when compared to Kotak Securities' estimate of about 2.5%. So the NII was actually down around 28% on a sequential basis. So net interest margin, to put it in a perspective comparison, was at 1.8% versus 2.54% in the previous quarter and versus 2% in the same quarter last year. So interest income has declined by 3.8% quarter-on-quarter. This is despite the fact that there was robust disbursals growth of almost 10.5% on a sequential basis. AM growth remained tepid at around 10.5% YOY and 2.6% sequentially, while PNL, both the NII and PAT, is way below our poll. Coming on to brokerages, Morgan Stanley has written on LIC Housing Finance. They have an underweight rating with a target price of 375 per share. They say that the PAT was 70% below their own estimate, which was driven largely by NII, which was around 34% below their own estimate. So provisions were higher, 72% higher than Morgan Stanley estimate. Loan growth was in line with Morgan Stanley estimate, especially given the fact that home loan has grown by 15% on a YY basis. Back to you.
All right, Abhishek, thank you very much for that. LIC Housing Finance Management coming up later on the channel this morning. Okay, all right. What we'll do is we will talk about Karnataka Bank as well. That is actually going the other way. It's a big mover on the upside. Abhishek, briefly.
Well, it's a strong P&L momentum this time around for Karnataka Bank, and stress in the balance sheet has also reduced. So interest income is up 8.7% quarter-on-quarter. This is despite the fact that loan growth is at a mere 2.6% quarter-on-quarter. So the NII has jumped by almost 16-17% on a sequential basis. Net interest margin has come in at 5-year high or 20-quarter high of about 3.56%. The PAT is up almost 125% YOY and about 228% YOY and about 260% on a sequential basis. The ROA, that surprised positively. It is coming at 1.7% when compared to 0.6% YOY and about 0.5% sequentially. The asset quality has improved. Gross NPA ratio is down about 65-70 basis points, while the restructured book share has also declined massively by 110 to 120 basis points on a sequential basis. Back to you.
All right, Abhishek, thank you very much. That's LIC on the downside and Karnataka on the upside this morning. Chambal Fertilizers is the other one, which is seeing some movement. Sonal is here with an explanation. Sonal, hi.
Hi Prashant, good morning. Well, for Chambal Fertilizers, there was a solid top-line growth, of course, driven by higher raw material prices, which was passed on. So revenue grew by 92%, but EBITDA declined 40% on a YY basis, leading to a decline in margins to the tune of 1,100 basis points and profit decline of 45%. Now, a couple of reasons why we saw this big decline in margins. Company says there was a one-time margin loss on P&K fertilizers to the tune of 237 crore rupees. There was a substantial increase in prices of imported fertilizers. There was negative forex impact as well, and losses on DAP subsidy, one of the fertilizers which was carried forward from the last year. And these are the reasons why margins were impacted this time. Working capital pressures were also seen this time around due to lag in subsidy payment, and this also led to a 60 crore increase in interest costs on a YOY basis in this particular quarter. So these are the reasons why a big margin decline. Additionally, company has updated on their technical ammonium nitrate project, where they are going to increase the capacity of this particular project project by 20,000 tons per annum to 2.4 lakh tons per annum. And there is a revision in the cost of the project as well, higher by 500 crore rupees to 645 crore rupees. So going by the calculation, it's much higher what they're paying for that additional capacity, and it is expected to be completed in next 34 months. These are the reasons why the stock is under pressure today.
Sonal, thank you very much. Well, the market is not doing very much at all. We're down about 30 points, 18,113. We'll take a quick break here. On the other side, our special segment, it's the economy. Lata will connect with Krishna Srinivasan, Director, Asia and Pacific Department, IMF, to discuss global economic growth. Stay tuned for that conversation.
Away from an all-important US FOMC meeting that may signal a slower pace of rate hikes here on starting December. But even if it does that, financial conditions are tightening around the world. To parse the impact of this tightening on Asia and on India in particular, I have with me Dr. Krishna Srinivasan, who is the Director of the Asia and Pacific Departments at the IMF. Dr. Krishna, let me first apprise our viewers of the IMF's latest outlook, the one that you also spoke about in Delhi. The fund recently downgraded global economic growth and that of most large countries and regions. It now sees global growth at 3.2% this year, 2022, and only 2.7% in 2023 next year, which will be the slowest in 20 years if you exclude the COVID year. In addition, the fund has cut the growth forecast for Asia as well by about 80 to 90 basis points for this year and next. The fund sees India's growth at 6.8% in the current year and at 6.1% next year. Now, with this preface, let me invite our guest, Dr. Krishna Srinivasan. Dr. Srinivasan, thank you very much for sparing time. First up, there is this meeting upon us, and so I wanted to ask you, even assuming that it is 75 basis November, 50 basis December, as the dot plot indicates, and another 25 or 50 coming in early 23, it is still nearly 5%. Do you think that this can be inimical even to Asia, where inflation is not so high?
Thanks, Lata. It's good to be here. Again, if you look at a World Economic Outlook, which we published in October, we have the Fed funds rate at 4.5% in early 2023. Now, what this means is that financial conditions for Asia, for countries in Asia, are going to tighten further. And, in many ways, central banks in Asia will likely have to respond by tightening here too. So you're going to see both an increase in dollar funding costs and in local borrowing costs. So financial conditions are going to tighten, will likely tighten for all of Asia, which means that there are risks of growth. And so we make some of these assumptions in our forecast, and but we also make the point very clear that downside risks are significant, and so growth in Asia, while at 4% for this year and 4.3% for next year, is subject to downside risks.
Okay. Well, Dr. Srinivasan, why I ask you is that there is an ongoing debate in India that we have done better with our macros. We did not splurge in terms of fiscal spend, and our inflation is not as bad. I mean, at 6 to 7%, yes, we are 2 percentage points above our target, but not like it is in the West, where it's a huge gap. Therefore, the debate here is: does India need to hike in step with the Fed at all?
So Lata, let me just add a couple of observations here. Some of the work we have done tells us two things. One, that core inflation, right? That inflation is brought into core inflation beyond headline inflation. Number two, that core inflation we find is a lot more persistent. And number three, what we find is that the pass-through from depreciation to inflation is going to be higher than what it was in the past. So for all three reasons, we think inflation is still going to be a concern for all of Asia, including India. And so the monetary tightening needs to stay its course.
There's another academic debate in which I want to draw you in. The Indian MPC, it's a young body. We constituted it only in 2016. And their given mandate is obviously domestic inflation. But the Reserve Bank, being Reserve Bank, for them inflation is one big prominent concern. But they have to look at financial stability, external stability. And therefore, the Reserve Bank perhaps would like to keep tightening because of the possible attack on the rupee. But external MPC members will stick to their mandate of domestic inflation. Do you think rate hikes are warranted merely to be a bastion for the rupee?
So what you're going to see is that, at a time when, look at what's happening to the exchange rate. It's basically the depreciation of the rupee, and in fact of all currencies in Asia and elsewhere, is being driven by two things. One is the terms of trade shock, which we saw right when there was a war in Ukraine began in February, and following that, a lot of the exchange rate movements are being explained by the interest rate differentials. So to the extent that these differentials widen, you're going to see more pressure on exchange rate. And so in one way or the other, central banks will feel the pressure to tighten. And I agree that there is an issue of trade-off between growth and inflation, but we worry that if you don't address inflation head-on, the impact of that could be significantly worse down the road. So you're better off addressing inflation head-on now, so that you anchor inflation expectations, you don't get unanchored, and so that you have more stability in that sense. If you don't tighten now, runaway inflation could be a problem. I'm here again. I'm not just talking of India. I'm talking of countries in Asia and elsewhere.
Well, actually, speaking of that, the report, the regional economic report that you said has, of course, only a few paragraphs for India. It deals with all the Asian and Pacific countries that are within your department. But what is your pecking order, and where does India figure at all in terms of relative resilience?
So again, compared to other countries in the region, again, let me put things in perspective. Asia is growing at 4% and 4.3% next year. Let's take an average of 4%. That is significantly lower than the 5.5% average growth for Asia, right? So compared to that, India at 6.8% this year and 6.1% next year is a relative bright spot. And, our reserve position is good. Things look much different in terms of macro fundamentals relative to, say, the taper tantrum episode. However, there are issues we have to worry about, right? Still the fact that debt levels are high at 84% of GDP, now are about that amount. So there are these worrying macro, which need to, there's a sense of caution which needs to be brought into the picture here. So yes, the headline growth numbers are better than for many other countries. Again, they are subject to downside risks. And given all the heightened uncertainty going forward, one has to be cautious in terms of policy formulation.
You are saying that our 6.1% also is subject to downside risk?
Yes,
because... Actually, let me elaborate on that. We've got RBI sitting at 6.2, which is a very, very preliminary forecast they give. They will refine it in subsequent MPRs, monetary policy reports. But the initial estimate is 6.2 for FY24. Most of the economists I have met are sitting slightly south of 6. IMF is at 6.1. Economists are between 5.8, 5.9, even lower, some of them. Dr. Anant Nageshwaran put up a spirited fight when you spoke in Delhi. He said he expects upside surprises to 6.1 because we could be at the start of a capex cycle. You're not buying that?
So, see, our projections are underpinned by two things. One is that the capex cycle will continue, and that consumption will also be reasonably robust, right? So, but the question is, given the fact that interest rates are rising, the question is how much of capex is going to materialize. So that's one question. So that's why I say that 6.1% is our baseline forecast. There are downside risks, not just domestic, but also external. External headwinds are rising. And so one has to take both the external headwinds along with domestic compulsions if interest rates continue to rise. And so that's why we say 6.1%, but downside risks.
Okay, I guess a lot of people on the street are believing that downside risk. You spoke about external environment as one big reason why you would put that downside risk. The way the stock markets are behaving, now that inflation appears to have peaked in the US and the Fed's, excessive tightening, front loading is over, and it will probably move down to 50 basis probably in the next meeting. There is actually a sigh of relief, and we are seeing a risk-on rally. Do you think that this kind of euphoria could be short-lived, and very soon we are going to see the impact of that 4% Fed funds rate or 4.5% Fed funds rate? Will we worry much more about growth slowdown next year?
I think so. I think clearly, we have. If you look at our numbers for the US for next year, it's very much, it's at 1%, right? For 2023, it's 1.6% this year, 1% next year. For the euro area, similarly, a sharp slowdown. And why is that? Because the rates have increased quite significantly across the thing. And so, if I had to give you one thing, I would say countries accounting for 30% of global output will be in some kind of a recession. They'll feel like recession. So it is coming. The slowdown is coming. And in many ways, 2023 could be worse than 2022. So one has to have a sense of caution here. And also, let's not forget that across the board, especially in Asia, the fiscal space is quite limited. So how are you going to, support the economy? So those are issues which we need to take into account when you talk about euphoria or the lack, or too much euphoria versus more realism.
Okay. Well, let me then, I have a few more minutes with you, so let me use that to get your view on the medium-term India story. If we are looking beyond 2023, the expectation is that, our fertility rate now is down to 1. This is the period of our demographic dividend. It may be much lower than what we would like it to be because of our literacy and health, perhaps lack of achievements. But still, it is there. It is a demographic, demographic dividend decade. And plus, I think, doing extremely well on digitalization, which is reducing leakages and probably empowering more people. Anyway, my point is there enough raw material to be bullish to expect 7% our aspirational growth beyond 24?
Beyond 24, I think our estimates of potential growth is at about 6%. Okay, and that takes into account two factors. We had even before the pre-pandemic, we had some issues there with we had the financial the NBFC's shock there, and then now we have the pandemic, where significant losses have risen. In fact, if you look at our regional economic outlook, the losses are quite significant, and they can be traced to three things: investment, labor, and productivity. Again, the question there is, it differs from country to country, but 6% is still a slowdown, compared to the past, right? So the question is, what can you do about it? And I think here, there are reforms which can be, taken into account. If you facilitate business creation by, say, land reforms, or if you talk in terms of spurring productivity by having labor market reforms at the state level, or you talk of catching up with education losses again. And finally, if you harness digitalization, there could be an upside to it. But there are one has to take into account the fact that the pandemic led to some losses which need to be recouped. So again, a sense of realism. We are at 6% for the medium term beyond 2024.
Okay, it's not a very good number, but yes, it's entirely in our hands. Nothing is inevitable. Political will can change a lot. Thank you very much, Dr. Srinivasan, for speaking to us. I would have loved if we could speak to you after the FOMC meeting when the global terrain would be much clearer. So I'll take a rain check from you for another meeting. Thank you very much indeed for joining us.
Thank you.
Okay, well, that's the backdrop in which we will head into. Some things will change with the FOMC meeting, but a lot will continue in terms of core inflation worries, currency worries, current account deficit worries, fiscal deficit worries, etc. And that's what Dr. Srinivasan is pointing to. Wrap up on Bazaar on the note that the markets are extremely flat, but a bit of positivity in the mid-cap, advanced declines in favor of advances. On that note, Chartbusters will come up for you.